Next is the SALT limitation. So what is SALT? We're not talking about table salt, but what we're talking about is under Trump's tax plan. I keep talking about Donald Trump's plan. This is one of the things that he did that wasn't so nice to people that live in high-income states like New York. So previously, when you itemize your personal deductions on Schedule A, you were able to deduct all of your state and local income tax. You were able to deduct your real estate taxes. And for a lot of people, they got a big tax deduction for the fact that they lived in a high-income tax state like New York. The caveat to that is a lot of people lost those deductions through what's called alternative minimum tax, but that's a story for another day. So when Trump imposed this rule, basically he limited that to just $10,000. Now most people that live within the 5 boroughs of New York, if you own a home, you're probably paying $10,000, $20,000, $30,000 a year in real estate tax, especially if you have a nice big home. You're also paying New York State and New York City income tax. Guess what? None of that stuff is deductible, which could hurt. So that's what the SALT limitation basically is. You're limited in those personal itemized deductions. Okay, so 2 years ago, we came up with a workaround to the SALT tax. And that basically is something that's available to you as a small business owner that has a flow-through entity. And when I talk about flow-through entities, this is going to apply to partnerships. It's going to apply to S corporations. This rule does not apply to C corporations. It doesn't apply to sole proprietorships. But for flow-through entities, it definitely will make a big difference. Last year was the first year they allowed this. We were on top of this extremely early. We notified all our clients. We got them all registered, and we took full advantage of it. So what exactly does this mean? Well, let me go back to this. Here's how it works. So let's assume you're a subchapter S corporation. You paid yourself a $500,000 salary because you have a very successful practice and you put in a lot of hours. Basically, any salary you paid yourself, you already paid the state and local tax through your W-2, and you sort of got the deduction for that through your W-2 form. But at the end of the year, you have a $200,000 profit on your practice. That profit is your flow-through income. On a $200,000 profit, for the privilege of living and working within the 5 boroughs of New York City, your tax rate's going to be about 12% of that. So that's roughly about $24,000. Through this program that we're talking about here, what you're going to be able to do is elect to pay that $24,000. You're going to pay it through your subchapter S corporation or through your partnership. It becomes a tax-deductible expense to your business. That's going to lower your taxable income. That's a big deal. Why is it a big deal? Because something that before was not tax-deductible on Schedule A personally now is fully tax-deductible at the business level. You just lowered your taxable income by $24,000 in the example I just gave you. Assuming, again, you're in the, let's call it the 37% federal tax bracket, you saved yourself not quite $12,000, but probably somewhere around $10,000 in taxes. What gets even better than that, not only did you get a tax deduction for it, but now you're going to get a tax credit personally as if you made a personal estimated tax payment. That's a game changer. This loophole, this rule that became allowable last year was even better than it was before the SALT tax came into existence, because you're getting a tax deduction at the business level, dollar for dollar tax credit on your personal return. So those of you that are in practice for yourself, do you pay quarterly estimated taxes as well, every quarter? Well, starting last year, your state and city quarterly estimated tax payments should have gone down significantly. As a matter of fact, they may have gone down to zero, because what you should have been doing is paying for those taxes through your S Corp or partnership and taking advantage of what I'm talking about. Now, you need to register for these programs, and every state is different. So it's not every state that allows this, but those states that do allow it, this is, in my opinion, a game changer. And again, maybe $24,000 tax deduction doesn't sound exciting to you, but it's exciting to me. The fact that you could save yourself easily $10,000 or more, and that is just assuming a $200,000 profit. There are certain dental practices that may be showing $500,000 profit or $1 million profit. The same rule applies regardless of what your profit is. So I have a list here of all the states that allow this. This is a state rule, and these states created this rule to get around the SALT tax limitation. So if you've never heard of the PTET program, it's called the Pass-Through Entity Tax, then when you leave here, give your accountant a call and ask them, have I been taking advantage of it? And if you haven't been, the next question you're going to have to ask them, why have I not been taking advantage of it? Unfortunately, it's too late to take advantage of this for 2021, but 2022, we still have about 5 weeks left. You could still implement this strategy. Again, these are the type of things we talk to our clients about. And again, when we talk about tax preparers, right? If you're looking to have someone prepare your tax return and that's all you're interested in, then you're missing a tremendous opportunity. So if the guy that you're using or the woman that you're using for tax advice is just preparing a tax return for you, to me, that's useless. That's just compliance. They're just preparing a tax return for you based on whatever happened. The single most important day of the year when it comes to your taxes, what is the single most important day of the year for taxes? Guess? What? Close. Most people say April 15th is the most important day. The single most important day of the year is December 31st. When you pop that bottle of champagne and scream Happy New Year and kiss the person next to you, hopefully it's your wife, right, or husband. At the end of the day, after you pop that bottle of champagne, you can't do much tax planning at that point. Right now, November, the month of December, our office, we are busier than we are during tax season because we're meeting, talking with every one of our clients during the month of November. We're open 6 days a week. A lot of the accountants are putting in 12-hour days. Luckily, I'm senior, so I don't have to work that many hours anymore. But this is when you need to be talking to your tax advisor so you can implement these strategies so you could save yourself a ton of money, okay? If you're paying your tax advisor $10,000 a year and not giving any of this advice, my suggestion is hire a CPA that is a dental practice CPA. Hire a CPA, not a CPA, a CFP that is a dental practice CFP. Why? Because even if you end up paying $20,000 a year for those services, which is pretty common, you're going to save yourself literally tens of thousands, if not hundreds of thousands of dollars every year in taxes. So it does make a big difference. If you're looking at professional services as a cost center in your practice, if you're looking at your practice management team as another place where you're spending money unnecessarily, you're looking at it completely in the wrong way. When you have your practice management team, every member of that team has to contribute to your bottom line. Clearly, when you hire a marketing company, if you don't see a huge revenue increase and more patients coming in, what are you going to do? You're going to fire that marketing company and move on to somebody else that's going to do a better job. It's no different when you're hiring a lawyer who specializes in working with dentists. They're going to save you a ton of money. It's no different with your CPA, tax advisor. They're going to save you many times whatever you're going to pay them in fees. So look at those fees, not as a cost, but what? A profit center. It's an investment in your practice that will not only make you more profitable, but it's going to allow you to keep more of what you make. Remember how we started out this lecture? We talked about giving the government the least imaginable under the law, what the law requires. No more, right, and no less. But also we're talking about keeping more of your hard-earned money so one day you could accumulate wealth, become financially independent, and you could actually retire comfortably someday. I think that should be everybody's plan. Okay, PTET, if you didn't know about it, now you do.